Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, there are growing concerns about valuations as AI-driven tech stocks lead the market to new heights. But is it just another bubble? The Dean of Valuation, Aswath Damodaran, is here with his insights. Then, high-flying stocks could experience a pullback in the near future following the market's huge rally. Should you buy the dip? And later, trouble for Tesla. The EV maker could be taking a back seat as competition ramps up. On the Barron's Roundtable, my colleagues Ben Levison, Andrew Barry, and Elizabeth O'Brien. We'll talk about three things investors ought to be thinking about right now. So, Ben, let's start with the jobs report. A William Blair analyst called it a Rorschach test. He said, whatever you think the market is doing right now, you can see it in that report.
That's absolutely right. The headline number was hot, 275,000 jobs. It was supposed to be closer to 200,000. But if you look deeper into the report, you saw that there were a lot of revisions lower to January and February, which made it much closer to that estimate. And then you also had the unemployment rate went up and wage growth slowed. And that you could take as a good thing because it means that inflation might be less of a problem. But it could also be an issue if it means that the economy is slowing. And I think that's what's going on with the market right now. It's sort of stuck between wanting these rate cuts, but also wanting growth to be strong. And you saw that in the S&P 500, which finished the week down about 0.2%.
Okay, so down slightly, but if you pull back the lens a little bit and look at the last few months, obviously a lot of momentum behind this big rally. But there's an interesting thing. You spotted that the momentum ETF had a very bad day on Friday.
Yeah, Friday was just an awful day for momentum. When we say momentum on Wall Street, they're referring to something very specific. It's a measure of how well stocks have been performing relative to other stocks. And they were these stocks were doing great. Everyone kept buying what had worked. And on Friday, they were terrible. It's things like NVIDIA, Intel, Broadcom. And I think this is just a sign that these stocks have gone up so much and gotten so expensive that really it was time for a breather. And this could mean that there is some sort of correction coming as there is a rotation going on in the market.
Those poor Intel investors that had not been doing well. What were you saying, Andrew?
Oh, no. I think one bullish thing is you've been seeing an interest rate decline, particularly in the Treasury market this year. So, in the last couple of weeks or so. So I think that's a bullish development. You're getting a 10-year Treasury getting back toward 4%.
Speaking of which, CPI number coming out next week. Ben, what do you expect?
Well, it's the headline number is going to be 0.4%. That's partially because gas prices have been going up. You shouldn't worry about that. It always goes up at this time of the year. Core inflation is going to go up 0.3%, which is actually going to be down from the previous month's 0.4%. And I think that's what we need to pay attention to. If it comes in relatively in line or even a little bit cooler, great. If it's hot, we're going to have a problem.
I thought you would give me a hot tip. I thought those were the actual numbers. This is what's expected.
This is what's expected.
Alrighty. So, Andrew, we saw an unusual thing happen this past week. On the same day, Bitcoin and gold hit a new high. Was that just a funny coincidence, or people worried about inflation? What do you think's going on?
I don't know. But the ancient store value gold is basically at a new high, and also the new kid on the block, Bitcoin. Let's start with gold. It finished Friday around $21.75 an ounce, and that was a record, up about 5% this year. But there's not been a lot of excitement about gold as it's moved higher this year. The biggest ETF has actually had outflows, and the two biggest mining stocks, Barrick and Newmont, are basically in bear markets right now. So there's not a lot of enthusiasm, but if you actually get some, I think gold could go considerably higher.
Central banks around the world have been big buyers of gold. That might be driving it.
Exactly. And on Bitcoin, you basically had Bitcoin approaching 70,000 on Friday, which is a new high, and it's up about 60+% this year. It's had a big move. All the world's Bitcoin is now valued around 1.4 trillion, which is a lot right now. So there's basically been a lot of enthusiasm, a lot of headlines about it. This was a disparaged asset class a year or two or three ago. Now it's getting greater respectability right now. You've had investment firms and private wealth managers are recommending their clients buy it. Plus, you have this scarcity issue, which Bitcoin bulls are talking about. There's only going to be about 21 million Bitcoin ultimately mined. About 90% has already been mined. So basically, there's not much left to go. And so that could be an issue.
And this thing called the halving is coming up.
Yeah, the halving is coming up sometime in April, and that's going to mean the amount of new Bitcoin created every day may drop from about 900 to maybe 500. The bulls say 500 is not nearly enough to meet all this new demand, and that Bitcoin could be headed higher. The bear case has been made by Warren Buffett and others is basically a digital asset, no intrinsic value, and very few uses.
Rat poison squared.
Exactly.
Elizabeth, speaking of rat poison, about exactly 50% of people were very unhappy with new SEC rules because they felt they didn't go far enough, and the other 50% were unhappy because they felt they were far too onerous. Tell us about that.
That's right, Jack. This past week, we saw the release of the SEC's controversial climate disclosure rules that require companies to disclose a host of factors about their environmental impact and also the impact the environment has on them, you know, the impact of climate change and whatnot. Now, they were scaled back considerably in response to company pushback, but like you said, environmental activists said they didn't go far enough, so no one was really pleased by these. And disclosure rules are important for companies with big environmental risks. In fact, this past week, Xcel Energy, a utility provider, said that its facilities might have been involved in igniting the big wildfire in Texas, the Smokehouse Creek fire, which is the largest wildfire in Texas history.
And to me, these risks aren't, I mean, call them ESG, call them whatever you want, but these are just the risks that we need to think about. I mean, if you own a utility, you need to be thinking about whether they're going to start a fire, because we've seen what happened before.
Absolutely. So what's the bottom line for investors, Elizabeth? Is this actually useful?
Well, it depends. I mean, if you're an investor who is interested in ESG, which stands for environmental, social, and governance, then yes, this is important information. Now, I don't know how easy it's going to be to parse. They're going to have to make it, you know, put into digestible form. But if you're an average investor in an average company or even an average mutual fund, now most of Americans' investments are tied up in retirement accounts and target date funds, this is probably less utility.
Although governance is always important.
It is.
Thanks, Elizabeth. Supercharged tech stocks leading the markets to record highs. But have AI stock valuations reached unsustainable levels? The Dean of Valuation, Aswath Damodaran, joins us next to weigh in. Enthusiasm over artificial intelligence giving a huge boost to the market, but some investors are concerned about big tech valuations. Experts have differing opinions on whether or not we're in a bubble, but my next guest says it might not be such a bad thing if we are. Joining me now is NYU Stern School of Business finance professor and the Dean of Valuation, Aswath Damodaran. Aswath, thanks for joining us on the show. Appreciate it.
Thanks for having me on.
So the B word, bubble, we're hearing it whispered a lot, and you actually take issue with that word. Can you explain?
For two reasons. One is, for the last decade, I've heard this word pop up over and over again. This is not the first time. And the second, the word itself connotes the signal that the person using the word is delivering is, I'm on I have the high ground here. And the people who are setting prices are shallow, they cannot be trusted. Once you say the word bubble, all discussion and debate gets cut off because there's nothing to debate. So I'd rather take the word out and ask the question, are you looking at stocks being overpriced? It might sound like I'm playing with words, but bubble, I think, sends a very negative message on the debate is over, you've overpaid, and there's nothing you can do about it.
Is there a valuation, or I should say, at what valuation would you say, okay, bubble or not, stocks are too expensive, I'm going to cash?
Plus, you're assuming that you're selling. To sell, you've had to buy. Most of the people talking about bubbles never bought the stocks that they claim are in bubble. So I think it's almost academic. If you've never bought NVIDIA, you've never bought the Mag 7 or the FANG-AM stocks before this, what business do you have even pointing to those stocks and telling me you're in a bubble? You've lost any basis for doing it because you've never owned the stocks. If you've owned the stocks and you've sold them, I'd love to know why you sold them. But I think that debate about should I sell becomes relevant only if you bought it in the first place.
Got it. So let's talk about NVIDIA. We've just seen that chart. You have labeled that as overvalued at this point. Can you give us your thoughts on where that stock is?
It's basically a $2 trillion company, which will require to be able to move the earth to be able to get to that 2 trillion. I mean, it's possible. I'm not saying it's a fairy tale. There is a possible path. But it's a very narrow path. I mean, I backed out from the market cap what NVIDIA would have to generate as revenue 10 years from now. And my estimate is in the AI business alone, they'd have to generate about $600 to $700 billion in revenue. And this is a market that by most estimates is going to be about $400 billion. And that leaves me wondering where the extra revenues are going to come from. So from that perspective, I think you're paying way too much given what you can get from this company, which is an amazing company with a great CEO. I'm not taking any of those stuff away, but you can have a great company that's not a great investment. And I think we need to draw a line between those two judgments.
That is a very important distinction. We just saw a chart of your valuations, and you have Alphabet as slightly undervalued at this point. Can you give us that analysis?
Both Alphabet and Apple, because this is about 6 weeks since I valued all 7 stocks. At that time, all 7 looked overvalued. Apple and Alphabet were overvalued by about 4 to 5%. Since I did that valuation, they've dropped enough in price that they become undervalued. And that's, I think, the message to take is you're valuing companies, your value will change, but the price is also changing. What looks overpriced today could become undervalued tomorrow. So don't give up on a company just because it's not a good buy today. If you love the company, there will be a time when at the right price you can buy that company.
Speaking of giving up, a lot of investors seem to have given up on PayPal. That stock was over $300. Now it's around $60. You think it might be worth a look here?
I mean, it's being priced as a very boring, low-growth bank, and I think PayPal is more than that. So I'm not saying PayPal's best days are ahead of them. Clearly, their best growth days are behind them. They have a lot more competition. But they deliver a service that people value. And I think they should be given credit for far more than what you see in that price right now.
Yeah, it's a lot cheaper than Visa, MasterCard, and other competitors. Aswath Damodaran, thank you so much for coming on. We appreciate it.
Thank you. Appreciate it.
It's not just tech stocks. Even Costco shares are trading at nosebleed valuations. What does it mean for your portfolio? That's next. We just heard from the Dean of Valuation on where he sees the market heading. For this week's cover story, Barron's is also looking at big tech valuations and the market as a whole. Their signs were due for a short-term pullback, but long-term, we're still bullish. Andrew, we just heard that some valuations are stretched, but the market is still attractive. Liz Ann Saunders, however, says that tech stock price-to-sales ratios higher than the dot-com bubble. You're kind of a value guy. What do you think?
Well, I'm with Liz on that. Price-to-sales ratios in the tech sector are very elevated and maybe back where they were in late 2021 before we had the big sell-off in the NASDAQ. You know, NVIDIA, for instance, is trading for about 20 times plus current year sales estimates, which is the highest in the S&P 500. And as Aswath pointed out, you know, the company's discounting a lot of growth right now, and they're going to have to sell a lot of microprocessors and a lot of to basically justify where the stock is right now. And you actually saw a reversal today in the stock. It hit a new high and then basically reversed to end the day about 5% lower. So it'll be interesting to see whether we've seen a peak in NVIDIA right now. And I also say there are other areas that you may want to be wary of in the stock market right now, even outside the technology sector.
Like Costco, for instance?
Yeah, I mean, Costco, for instance, is a favorite stock. It's a great company. It's extremely well run. It's got a fanatically loyal customer base, but it's trading for around 45 times, I mean, this year's estimated earnings. And this is a company that grew sales in its latest quarter around 5%. And in fact, you saw a pullback of around 5 or 6% on Friday after they reported earnings because investors were a little bit disappointed with the results.
Of those big tech stocks, Aswath pointed out that Apple and Alphabet maybe look fairly valued. What do you think?
Yeah, I'm with them on both of that. I mean, Alphabet is trading now below a market multiple, around 20 times this year's earnings. There's obvious concern about the threat of AI to their core search business, but it's a great company. Probably will be paying a dividend later this year and about 20 times earnings, and it's looking pretty good right now. I think they'll get it right. Apple is another one. It's down about 10% this year, among the worst of the major technology companies, and it's trading for about 25 times this year's earnings. If they can get some stuff right with AI or some other things they're working on, the stock could be heading up from around 170 back toward 200.
And Apple, it rarely drops like this. It's dropped so much below what's called the 50-day moving average. It's a technical measure that people want, that they're now referring to the stock as being oversold and might be worth a look just based on the technicals.
We have a former colleague who used to refer to technical indications as reading the entrails of sheep. But that said, some people also find it useful. Ben, what is the technical indicators, the charts, tell you about the rest of the market?
Well, it tells me that basically the same kind of thing that we've been hearing is that the market went up a lot lot, and it's pretty extended, and that it's well above its 50-day moving averages, 200-day moving average, and it's also looking a little bit exhausted. We're seeing these stocks that helped lift it up so much roll over a bit. And this is actually what's interesting about looking at the technicals. I use them as a way to manage risk. It's when you want to enter positions, when you want to exit positions, that kind of thing. But it's really great when the technicals line up with the fundamentals. And what we're also seeing is that technicals are weakening at the same point that we're hitting these very high valuations.
So, Ben, what I'm interested in, if you think we are headed for a bit of a pullback, when might that happen? Is it going to happen by April 15th? Because I have not made my 2023 contribution to my IRA yet, and I'm kicking myself for not getting in and missing some of those gains.
Well, that's the thing about market timing, is that you're never going to get it right all the time. And so this is really about risk management. And so if it were me, I'd probably put some in now, maybe wait a little bit and see what happens, because people who've been predicting correction for a while have been wrong, and you can still see the market go up a bit.
And if you are going in, what areas of the market look attractive?
Well, I think you have to look down market cap. It's the large caps that have done so well, and we're now seeing that there's a comeback in things like the RSP, which is the equal-weighted S&P 500 ETF. That's been doing pretty well, and you're also seeing it in small and mid caps. I think actually small caps finished this week higher, even though S&P had a tougher week. So I think that's where I'd be looking.
Yeah, and as much as we all want the pullback to happen on our individual timetables, what really matters, as they say, is time in the market, not timing the market. So don't worry too much about timing. Get in and stay in.
That's not as much fun, though, Elizabeth.
It's not, and it might not sell as many, articles, as many magazines. That's for sure. But
it's a
buy
much
and hold.
better strategy.
Yeah.
But still, I'm going to ask you, Andrew, before we sign off, give us something you like in the market right now, either a stock or a sector.
Well, I think the banking sector is looking pretty good right now. You're seeing strength in some of the leading banks like J.P. Morgan. Citigroup is a turnaround story. Wells Fargo has been trading better. Even Bank of America, which is a big laggard, is doing better. So I think if the economy it holds up this year, it could be a pretty good sector with 3-ish% dividend yields there.
And it's interesting, the big financial center banks seem to be doing better than their smaller brethren.
Well, it's like the Goliath is winning. That's been the theme from Mike Mayo, who's the Wells Fargo bank analyst, and I think that's been the case.
Could be a technical, the tech is expensive, and maybe the big guys don't.
Yeah, you're talking about 10, 11, 12, 13 times earnings, which is not all that expensive right now. And these companies are basically distancing themselves from their regional bank peers right now.
And Citigroup and Wells Fargo both have things that they're working out, issues that they're working out for themselves that could give them a lift.
Yeah, Citi's a self-help story, and Wells Fargo's got this asset cap which has been lifted, which is definitely a positive for them. And Morgan Stanley and Goldman Sachs are plays on a merger and acquisition revival this year.
All righty. Andrew and Elizabeth have more investment ideas, and Ben says, watch out, Tesla. There's another EV maker in the fast lane. Stay right there. Ben, we've talked about a lot of the Mag 7 stocks today, but we haven't mentioned Tesla. Investors are not happy with what's going on over there.
Now, Tesla stock is down 29% this year, and it may still be part of the Magnificent Seven, but it's no longer one of the 10 biggest stocks in the S&P 500. It's very easy to just say, hey, this is an EV problem, but that's not really it. Tesla has a lot of its own problems. Its sales are just not what it used to be, and its margins have been shrinking. And you even have the bulls on Wall Street, people like Adam Jonas over at Morgan Stanley. They're starting to get nervous. They're pointing to this slowing car business as a real problem, because you can't have these big gains off of autopilot and subscriptions and things like that unless the car business is doing well. And now you're seeing other automakers, the competition is getting really stiff. We had Rivian come out with 2 new models, and not many people are going to buy these Rivians, but it's just a sign that Tesla really needs that new car, which isn't expected until 2025 at the earliest. So I look around and I see all they have is the Cybertruck, and that's, hey, if you like the Road Warrior, that's a great car to buy. But Musk is meeting with Donald Trump recently. I know Al Root, who covers Tesla for Barron, thinks that one of the big things Tesla needs is to convince Republicans to buy EVs. Maybe this meeting between Trump and Elon Musk can solve that problem.
I think he also needs to focus on the core business. He's got this OpenAI lawsuit. Twitter's gone down from the $44 billion he paid to about $12 billion now, according to Fidelity. Get back in your lane, Elon. All right, let's go to some actionable ideas. Andrew, what do you have for us?
Well, I would say to avoid MicroStrategy. It is a Bitcoin play, and the stock's gone vertical recently as Bitcoin has basically hit a record, but you're paying a very high price for the Bitcoin that this company owns, about 200,000 Bitcoin. The market cap is almost 25 billion, which is almost double the value of the Bitcoin it holds. So if you like Bitcoin, I'd urge investors to consider ETFs like the iBit, which is the BlackRock ETF.
Doing the math, Andrew.
Yeah.
Thank you. Elizabeth, what do you have for us?
So I'm looking at Mercado Libre, which some are saying is an alternative to the Magnificent Seven. It is Latin America's Amazon equivalent. It's a big e-commerce company. It just had an earnings disappointment that some are saying created a buying opportunity. Earnings per share are expected to jump 80% this year. So it's definitely worth a look.
Well, sounds attractive. Thank you, guys. Ben, Elizabeth, and Andrew, all great ideas. To read more, check out this week's edition at Barrons.com. Don't forget to follow us on X at Barrons Online. And that's all for us. We'll see you next week on Barron's Roundtable.